Just looking at the fact that India is the largest market for gold worldwide, what role is it playing in the sustainability of gold prices at current levels? Yesterday, we saw that $1,424 an ounce level breached in terms of a new all-time high being set on the yellow metal.
Absolutely. Well, India is the largest market in the world by tonnage and by dollar value. Alone, it accounts for about 16% of annual demand. And it's worth remembering that India has no mine production to speak of, so all of that gold is imported. Since 2009, the market's been recovering from the hit it took in that year to demand as a result of the credit crisis and the impact of recession in Western countries flowing over to India. But we're seeing a strong revival in demand now in the Indian market, and we're expecting it to recover to 2008 levels or possibly more by the end of this year. So the profile at the moment is very strong in India, and initial reports of the Diwali festival are also positive in terms of demand.
Marcus, Ashraf Mohammed here. India's traditionally bought gold for jewelry purposes. Are they buying it for investment purposes now, or is it still jewelry demand that's causing the growth?
Yes, it's a very interesting question in India, because I think the traditional division between investment and jewellery demand is much more complex in the Indian market. Quite a lot of jewellery is bought for investment motives or wealth accumulation motives, as well as for adornment and for religious festivals and the marriage festival. So I think there's a degree to which these categories do merge together in India in a way they don't in other cultures. But the bottom line in terms of gold demand is in Q2, jewellery demand recovered about 67% from the low in 2009. Sorry, that was for the first half of this year against the first half of last year. Investment demand, and this is specifically bars, coins and the physical backed ETFs that you have in the Indian market, they grew by about 264% in the first half of this year over the first half of last year. Now, investment demand is about 25% of demand in India, but as I said earlier, it's growing more rapidly than jewellery demand. It rose about 264%. So you are seeing a growth in investment products and a growth in demand for investment gold and bullion gold in India. But I think you have to remember that quite a lot of the jewellery demand is also driven by investment and wealth accumulation motives as well.
Marcus, it's Adrian Saville. I'm interested, I know that this piece is not about the price of gold, but I would be really interested in hearing your views on what you think the two biggest drivers of the gold price are, perhaps at this juncture as well as more broadly over sweeps of time. And related to that, if you were to build a model of how to arrive at a fair value for gold, what would that model look like?
A very good question. I think whilst the Indian market is underpinning the demand for gold and the price around the world, and the strength of the festival season is very important in that regard, and seasonally this is usually the strongest time for physical demand in the gold market all the way through to Chinese New Year early next year. And you've seen it in the high levels of physical premiums there are. We track those premiums daily at the World Gold Council, and they've remained strong throughout this rally in the gold price. But I think the drivers at the moment of the strength of the gold price are actually more to do with Western investment demand, and also to do with the fallout from the FOMC meeting, the second round of quantitative easing, and the impact that is having, causing currency conflicts around the world, leading to effectively competitive devaluation and tensions between the deficit countries that need to devalue to restart economic growth and need to continue to implement quantitative easing, and the surplus countries with strong economic growth or where their currencies are perceived as safe havens, where they see QE and devaluation as a competitive policy against their economies. And they are fighting against the revaluation of their currencies against the US dollar and against a lot of the Western currencies. And I think these are the issues that are currently driving the gold market and demand for gold as an asset class and as an investment asset from consumers all over the world, in addition to the traditionally strong period of jewellery demand you're seeing in India because of Diwali, and also very strong demand in China as well. So you've got very interesting influences in gold at the moment. It's trading like a macro asset class on the one hand, driven by the current economic situation and the currency conflict and the statements by the president of the World Bank on Monday. But on the other hand, it's still being driven by the physical demand factors, especially in Asian markets where there's still very strong demand for physical gold, both for jewelry and for bars and coins in particular.
Marcus, I want to focus for a moment on the negative correlation with gold and the US dollar, and clearly being illustrated today. Yesterday, hitting that new all-time high, we see euro dollar going to the 137 level and gold pulling back below $1,400 an ounce today. I'd be interested in your views on the dollar longer term. Do you see the dollar coming under significant pressure over the long term, and would you back gold as a direct result of that negative correlation with the dollar?
Well, I think the negative correlation of gold with the reserve currency of the day is a well-known facet of gold, has a long history in that regard. I think what we're seeing now, though, is a more broader debasement of fiat currencies, including the dollar. And I think if you look at QE policies, you look at the lack of economic growth in North America, the difficulties in getting back on trend growth and trend inflation levels in countries in the West, in particular in the United States, I think you conclude that you're going to see a weak dollar in the medium term, and you're going to see other European and Western currencies also remain weak, not least because of the balance sheet problems there are in terms of sovereign debt. And we're seeing a return to that in Europe today with the increase in spreads for Portuguese and Irish bond issues at the moment. So I think all of those things undermine the European currencies, and they also, in terms of QE and the lack of growth in the United States, mean you're going to see a long-term weakness in the dollar. And naturally that does favour gold, as you rightly say. But I think there's a broader re-evaluation going on of the dollar's role as a reserve currency. And that is what triggered the comments by the president of the World Bank on Monday about a return of gold to a more prominent role in a new financial architecture. Not a return to the old gold standard, but a return to a higher prominence of gold in reserve asset management. We're already seeing that because central banks are buying gold, but also possibly a further increase in its prominence, perhaps, for example, in a special drawing right from the IMF, which would include gold as well as some of the currencies that are not currently included, such as the Chinese currency, given China is now the second largest economy in the world. So I think, first of all, you're right, long-term negative correlation with the dollar in general, long-term weakness in the dollar we expect, but we think there's a broader reassessment of fiat currencies going on as well, all of which is favourable to gold because it is the ultimate hard currency.